metal. And even in that context, the price has been manipulated. In my opinion, the main manipulators of the price have been the Chinese. And JP Morgan probably, again, I'm assuming, probably has instructions from the Chinese to try and keep the price down. Well, I think possibly. The way to look at silver is that it's not being priced as a monetary metal at all.
Yeah.
It's being priced as an industrial metal. And even in that context, the price has been manipulated. In my opinion, the main manipulators of the price have been the Chinese, who are, third or fourth largest producer in the world, maybe fifth, I don't know. But for a long time, they have been bringing in silver doré from other nations and refining it, because refining is a dirty business. Nobody else wanted to do it. It was also a costly business, and the Chinese were very happy to accumulate silver. So I think they've accumulated a lot of silver, which basically nobody knows about, or it hasn't been really recorded. And it's allowed them to, if you like, put it this way, hedge their positions in the market. So the silver they buy in the form of doré doesn't go through the market, is priced relative to the market. It doesn't actually go through the market. So there's no sort of supply and demand consequence of that. But it does mean that they can hedge the price in order to suppress the price. So what they do is they come in as a producer through a major bank like JP Morgan, and they sell futures to suppress the price. And JP Morgan probably, again, I'm assuming, probably has instructions from the Chinese to try and keep the price down. So the dealers on the JP Morgan desk will look at, the current situation, whether the longs are in there, and whether they can shake them out, by hitting the market with some more shorts, hedging positions from, on behalf of China and so on. It's been very effective. So much so that if you look at the Silver Institute's numbers, they reckon over the last 5 years or so that silver has been in supply deficit. I mean, this is not something that can go on forever. And again, you see the Chinese. You've got to think, it's all going back to China. If you put yourself in the Chinese shoes, and you sort of look at it from their point of view. The dollar's now going down. They can see that. They've worked that one out. Because believe it or not, the People's Bank of China has overall responsibility for the buying and selling of silver as well as gold. So it's basically the same people. And if they think one thing for gold, they're bound to be thinking the same thing for silver. Where this matters is that China will now be thinking, why should we supply silver into the market to keep the price down? There's no point.
Yeah.
Because it's not silver going up or whatever, it's the dollar going down. We've got to accept that fact. So you can see that things are changing for silver, and I think they're probably changing quite rapidly underneath. The other thing I noticed, which was very interesting, was in 2023, which were the last full year figures we had. I think the supply deficit, according to the Silver Institute, was something like 250 million ounces or whatever. Interestingly, China's exports of silver were almost exactly that figure. And not only that, but in 2023, the exports went to Hong Kong, Singapore, London, financial centers, not manufacturing centers. So I think that that was confirmation of my theory that actually it's the Chinese who've been behind the price suppression. I would therefore go further and say that, in my view, it's no longer in their interest to suppress the price. So when the shorts on COMEX, for example, or in London, sort of fully realize this, I mean, they don't want to get caught, because it's a very illiquid market from the point of view of what they're doing. They will continue to try and manage the price down so long as they got short positions. And they'll continue to manage it down if they got the chance of going long. Yeah. That's really where they want to be. So we're not necessarily out of the woods on this one yet, but you can see where the general direction is going. Now, I would also say that for people who feel that they've missed gold, once they see silver starting to run, they will probably go and buy silver. For two reasons. It's been left behind, as you put it. And the second reason is that, it's a lot easier intellectually to buy something worth, say, $35 rather than something like $3,500. So I think, I think it will attract quite a lot of investment interest on that score. So, things like silver ETFs and so on and so forth. I think you're going to see a lot of demand in the future going via that route. No, it's not at all. I mean, I think there's quite a lot of misunderstanding about this. I mean, basically what they've said about gold is that it's a high quality liquid asset. But the definition of that has got nothing to do with where it sits, if you like, in terms of being an asset, a risk asset on a bank's balance sheet. So therefore, I mean, if when it comes to the Basel III calculation, there are all sorts of things that are high quality liquid assets. You've got government bonds, obviously you've got cash, you've got bank deposits, or reserves, if you like to call it, bank deposits at a central bank. You've also got corporate bonds, you've got equities. Anything that can be sold easily and quickly is a high quality liquid asset. But the haircut as an HQLI that you suffer on gold is 85%. 85% in terms of the funding on the other side of your balance sheet. The other side of your balance sheet being liabilities. So, and that gives you your tier assets. The tier one asset obviously is equity, equity which is actually on the balance sheet, and obligations, loans from diverse loans. For example, from many small deposits. You find that because we now assume that people don't queue up around the bank when they get worried about the bank's liquidity, basically, if you've got lots and lots of little deposits, that is better than having a few big depositors. So, this is the way in which the Basel III does the calculation nowadays. Now, I mean, I keep on reading people saying, well, gold is going to be a tier one asset from July in America. No, it's not. It's an HQLA. I mean, as a tier one asset, I mean, no, it's just not the case. What has happened is an exception has been brought in. And this is very much after lobbying by the London Bullion Market Association, whereby a bank which actually holds gold as an asset doesn't have to take that 85% haircut in terms of its funding requirement, so long as that gold matches a liability on the other side of the balance sheet. In other words, gold is covering a gold paper liability on the other side. So, for example, a bullion bank might offer for a facility whereby you can open an unallocated gold account. Now, the way an unallocated gold account works is that no gold is allocated to it. It's not your property, it's the gold's property, and instead of the deposit being, let us say, in the form of fiat currency, it's actually in terms of gold. So you can demand settlement in gold. Therefore, the bank has to have a balance of gold against the possibility that its customers might demand a settlement in gold. Now, you can then see that if you just have bullion as an asset matching those liabilities on the other side, it makes sense. And that, therefore, is effectively outside the calculations, if you like, the risk calculations which a bank needs to undertake. So that's what that is about, it is a major and sensible step forward. But that's already in the works. I'd be very, very surprised if that has any impact on the American banking system at all. Because apart from anything else, their banks operate in places like London. They can do their balance sheets wherever they are. Really, it doesn't matter. Keep staying out of credit. Keep stacking gold. Keep getting out of credit.
That's it.
No other advice. I don't give investment advice, but anyway, I would say that is actually all you've got to bear in mind. We've got a credit bubble, it's going pop. And at the same time, you've got Smoot-Hawley Tariff Act, Mark II. First one was in 1930. Think what happened in those days to Wall Street, 1930. Yeah, it lost 85, 90, nearly 90% of its value. 9,000 banks went bust. So, nowadays you don't have the currency underwritten by gold or convertible into gold, which it was until 1933. You have a currency which will reflect all those ills.